Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss stock market speculation trade, tariffs and inflation, tariffs expand export taxes, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Doing well. It's going to be a big adjustment. Our oldest just left for college, so yeah, it's going to be a little quieter around here, a little different. We'll have to adapt.
Yeah, I am. I'm around the corner. I got the SATs with the oldest this weekend, and taking the youngest for early 16th birthday, little Niners game there, a little preseason action. So getting used to that idea that, boy, there's not a lot of time necessarily under my roof left. We'll see, but
yeah. There are periods, you age very slowly, and then there's periods where you feel like you age very quickly, right? As you hit these milestones. So it is interesting.
I guess it does present for us sooner the opportunity where our kids will be like, "Hey, we're going to come visit you," and I'll be like, "No, I'm going on a cruise with the Armour. Sorry, won't be here." Well, we got some great topics, so let's dive right in. Stock market speculation trade. There are three trends that have emerged in the U.S. stock market, which are often signs of short-term, high-risk speculative investments. What are those three trends that we're seeing here?
Yeah, so it's always interesting when you start seeing these patterns, right? And when you see kind of three different things confirming that pattern, it definitely gets your attention. I think the first one is we've had a number of companies go public through an initial public offering, right? Which usually is a sign of a strong market. Companies tend to go public when the market's strong. But what we've seen is just like unbelievable performance of these companies on the first, days, weeks, months. A number of the companies, they've increased in value by 100 to 200% on their first trading days. In some cases, up 300 to 500% in a month or so. So clearly a sign that people are really, piling into these stocks once they're available to public investors. And most of them are, unproven companies, right? They're not profitable. They're in unproven industries, things like crypto and AI, where really we've yet to have a company, demonstrate a path to profitability or how the industry may be able to get there as a whole, much less an individual company. So it's obviously these are very risky investments, really based on speculation of what may come or what could happen. So the fact that we're seeing such strong buying into these different areas is a sign that there's at least a certain segment of investors that are looking to take really high risk on these different types of stocks.
Why do you think there is so much of a willingness to take that risk around these stocks? Is it that when the IPO, the initial public offering, comes in, it's not at an incredibly high rate? They can get a good amount of stock in it at a I don't, bargain buy isn't necessarily the right wording, but I'll use that.
Well, in many cases, you can't necessarily even get in at the IPO price, right? Unless you're one of the initial people that does a lot of IPOs with certain investment banks. Maybe you can get access to a little bit of it if it's what's called oversubscribed, meaning it's even difficult for those who are active in that market to get much of an allotment. And then, there's so much buying, and on the first day, the company, typically it doesn't open at the IPO price. In some cases, opens well above it. Great example would be one recently. Figma came public. I think the IPO price was $33. It took several hours for it to even open because they had to try and figure out what's the price where, it could clear. And I think the first price that was posted was $85. So, even if you were one of those first buyers going in, you're buying in at $85. And even from there, it continued to move up, with a lot of subsequent buying. So, yeah, I don't know if it's more short-term investors thinking they can get in and it'll, pop and make a quick profit. If it's people that are very optimistic about the, future potential for AI and, what some of these companies are doing, and they want to get some exposure, once it's available. Or if just kind of these things being hyped up ahead of the IPO and people buying into that hype.
Yeah. All right. What is the second sign that we're seeing as far as these returning trends?
Well, we're seeing a return to the meme stock trend, right? So I know we talked about this as back in 2021 when the term was originally coined. Back then, it was GameStop that most people were talking about, right? But it was GameStop, AMC, Hertz, some of these others, where basically a group of investors would get on a message board and identify companies that were experiencing financial hardship, and in a lot of cases, probably on their way to bankruptcy, right? And that they had a lot of short interest. And what that means is a lot of professional investors were betting against the stock by borrowing shares from another investor and then selling those shares.
Mm.
And their goal is that they'll be able to buy back the shares at a lower price. Or if the company goes bankrupt, those shares will basically be worthless. They'll just be able to keep the money that they sold the original shares at. And when that happens, you can end up with what's called a short squeeze, where if a lot of people start buying the stock and pushing the price up, those short sellers are now losing money, right? Because potentially they'd have to buy those shares back at a higher price. And in some cases, if they're leveraged, they may even be forced to buy back the shares because, any investment bank that lends them money on that is going to, protect themselves, make sure that they get paid back. So it can create a situation where you have, these investors on an online message board buying a lot of shares, pushing the price up, and then suddenly the short sellers have to come in and start buying, either to limit their losses or because they're forced to buy. And so you can get kind of a one-sided trade where there's a lot of buyers and very few sellers, which can cause the stock price to go up rapidly. I mean, sometimes 200 to 300% in a month. But of course, this is really risky because you're basically buying into a company that doesn't have a lot of fundamental value.
Right.
This isn't like a Fortune 500 company where you buy it and the market goes down. Sure, the price goes down some, but that company will be there tomorrow. It'll probably be there in a decade, right? There's real fundamental value to that business that you can count on and be patient. With these more speculative meme stocks, if you buy in and a lot of other people start selling, you can end up in a situation where you're holding on to a company that really isn't worth very much.
Yeah. Well, and I don't know if anybody saw the movie around the GameStop scenario. The trailer did a good job of presenting the main character, and yes, he did make out good, but there was the far majority of people that lost a lot, if not everything. So it is an interesting scenario that this was occurring again.
Kind of by definition, that's the way it has to work, right? For the stock price to hit a high, there's got to be a lot of money coming in at the end.
Yeah.
And then when those original investors start selling and driving it down, yeah, those late investors can take a real hit. And again, there may not be any point to them continuing to hold the stock long term because the fundamentals just don't justify that. So, it's to an extent, I would label this as the bigger idiot theory of investing, right? I can pay a really high price because I assume there's a bigger idiot that'll come along and pay an even higher price. I prefer not to engage in that type of investing because I always worry that I'll wake up one morning and find out I was the biggest idiot, and the investment world had run out of idiots that were going to pay even a higher price, and I'm going to be stuck with something that I really don't want to own long term and really isn't worth nearly what I paid for it.
Yeah. What is the third area that we're seeing as far as the stock market speculation?
Yeah, so this is kind of related in that there's been a big increase in margin debt. So that's money borrowed to invest in stocks.
Hmm.
So typically a sign of a high level of speculation in the market. In June, we saw a big jump. The amount of margin debt outstanding increased by 9.5% just for the month and surpassed the 1 trillion mark for the first time. So a lot of borrowed money in the market. And investing in stocks already comes with a high level of risk, right? For the potential for short-term volatility, borrowing just magnifies that. And so really you need the market to go up quite a bit to make money, but you can make a lot of money if the market's doing well. But unlike normal stock investing, if the price goes flat, normally the stock market might go flat for periods. Maybe you just collect some dividends, wait, and kind of wait it out. If stock market goes flat, you're actually losing money because you're paying interest on the
Right.
money that was borrowed. And of course, if the market goes down, it can lead to really large losses and even a total loss. If it goes down and you end up being forced to sell those investments to pay back the debt, the margin debt, because the institution lending you the money is going to force you to sell, to make sure that they get their money back.
Right. I think you answered my question there. I was curious about what types of borrowing occurs with this when it's that margin debt. Is it like getting a standard bank loan, or what are the situations? Is it borrowing against other stock that you had mentioned? What would that be?
Yeah, so margin loans are basically loans that are taken out by a custodian, from a custodian that holds your investments. And yes, you are using your investments as collateral, right? So if you have $100,000 invested in stocks, you maybe go and borrow an additional 30,000 or up to 50,000. And then you're able to buy, 130 or 150,000 worth of stocks, which of course, if it's going up, your return on your original 100,000 invested could be a lot higher than you'd otherwise get. But if it goes down, if we see a big market decline, then suddenly, your losses are that much bigger. And if it goes down a fair amount, you could be in a situation where, you still have all this debt and, your 100,000 drops significantly by the time you're forced to pay off the debt.
Right. Thank you. Appreciate that clarification. So speculative trading, good sign, bad sign, bit of both.
Bit of both. I think really what it is a sign of where we are in the market cycle, right? If we look at past market cycles, we see a high level of speculative trading, usually comes in at the end, kind of the end phase, right? Now, we've only been seeing this for about the last 4 months. So, maybe we're at the beginning of the end, right? Rather than the end of the end, if that makes sense. That
Yeah.
we still, this expansion, growth phase in the market may still have a ways to go. But it's a sign that we're probably getting close. To use a baseball analogy, maybe we're in the seventh inning stretch, right? Right between the bottom, top and bottom of the seventh inning. So there could still be a ways to go. But if we look at past periods, it's hard to say how long these cycles might last. In the late 1990s, it lasted for 3-4 years, right?
Wow.
We had the Fed chair, Alan Greenspan, at the time warning of irrational exuberance in 1997, and the market didn't peak until early 2001.
Hmm.
So, that was a pretty long speculative cycle. Of course, it also led to a pretty long and sharp correction. But meanwhile, if we look at 2021, where we had the meme stocks that we discussed, we had a lot of speculative investing in SPACs, special purpose acquisition companies, which we haven't seen and did not work out well. We haven't seen this time, but did not work out well back then. But it only lasted for about a year. And then we had the correction in 2022, which wasn't fun, but it was pretty mild by historical standards and only lasted, it took, I think, 13 months for the market to recover to its previous high. So the shorter speculative cycle led to a shorter, more mild correction. So, we're going to have to be really vigilant to kind of monitor how long this last phase of this cycle may last, because that'll also give us an idea of how big the correction may be.
Yeah. Well, and as we point out, whenever we get into the stock market, you always make it clear that it's important to understand that it is cyclical, and there's different kinds of cycles, and they come with ups and downs, and you need to have that preparation in the up periods and be prepared as well for eventual downs. It's going to happen.
Yeah, it's going to happen. I mean, when the market's at, hitting all-time highs, there's a tendency for people to become very complacent, start ignoring different risk factors. And the truth is, right now is probably a time to be especially cautious and vigilant, because of what we're seeing in the market. It's important to participate in those last kind of last several innings of a market cycle because that's often when a lot of the returns occur. But also realize it's not going to last forever, and have a risk management and plan to be prepared for the eventual correction. That history shows will come.
Yeah. All right, let's dive into tariffs and inflation. Many economists predicted that U.S. inflation would surge following the large and broadly applied tariffs announced by the White House on April 2nd. Yet, we're over 4 months later. The increase in prices that were predicted haven't really materialized.
Yeah, we haven't seen it flow through the inflation data. We haven't seen too much of it in the retail sales or retail companies' earnings reports. But and it might be. I think trade policy is so complex, right? I mean, I've read up on it a little bit. It always some fascinating things. You ever buy like a pair of jeans and it's got this weird little pocket, right? And you're like, what's that pocket there for? Well, believe it or not, that pocket may very well qualify it for a different tariff rate.
Wow.
And so they throw that on there because everything is defined in such detail. You add some little thing to it, and now suddenly it has a lower tariff rate, right? And of course, the manufacturer will look at it and say, hey, the cost of adding this little addition is less than what the additional tariffs would be. So that's why they do it. So you get some really weird things, and these deals are very complex. Obviously, there's been a lot of announcements out of the White House of these high tariff rates on this country and that country, but it may be that those countries are really not paying those tariffs across the board.
Mm.
There's a lot of carve outs. There's a lot of different situations where the tariff may not apply, or there may be a lower tariff rate based on existing trade agreements. Probably the most extreme example would be Canada. Canada is our biggest trading partner, so obviously any trade policy affecting Canada will have a big impact. We're not just looking at the 35% tariffs that have recently been applied, but you also have the U.S. Mexico Canada agreement, which was the trade agreement that replaced NAFTA in President Trump's first term, which resulted in zero tariffs for any goods that conform. And so what we've seen is, before this year, only about 40% of Canadian imports conform to the USMCA to avoid the tariffs. And that was because goods that didn't conform paid a very small tariff. And in a lot of cases, companies may have looked at it and said, it's better to pay this really small tariff than to hire a trade attorney and, do everything that it would take to make sure that it's certified with the USMCA. But what we've seen recently is a big increase on the number of Canadian exporters that are conforming to the USMCA. It's now above 90%
Wow.
of imports from Canada, and potentially even growing from there. So, in fact, the high tariff announcement really applies to a relatively small percentage of the goods that are being imported from Canada at this point.
Yeah, it's really interesting, and that's one of the things I appreciate about the personal financial review is to get that greater detailed information because I certainly didn't have that understanding. Hey, guilty. See the headline: imports increase on country whatever. Oh goodness, everything coming from there, it's going to be, but it's not always the case, and I think it's important for people to understand that. I think that's an incredibly important part of it to understand. It's not necessarily all goods that are coming in.
Right. Yeah. And that's part of the thing that's very messy and I think challenging for US importers and, trying to sort this out, right? Is there a way to get around the tariffs because of terms of a pre-existing agreement that is still being honored? Are there certain carve outs that, maybe you have a lower tariff rate or no tariff because that's part of the negotiation? Or will that headline number actually apply? And obviously, how do you adjust your business accordingly? So, it's just so messy, complex, that really what we have to do is just continue to watch the end data, that inflation data to see if this is going to materialize or not, because of all the different moving pieces. It's really not something that can be accurately predicted.
Sure, sure. And I'm not sure that this is a prime example, but I mean, maybe auto manufacturers, it's why, final assembly might happen in the United States or something along those lines. I mean, I'm just throwing that out. I don't know if that's fact, but it would make sense to why maybe a company would shift a large, let's say, Asian auto manufacturer if that then gives that advantage.
Yeah. Oh, yeah. I mean, components could be, tariffed at a certain rate or even exempt from tariffs, whereas the final product, could have much higher tariffs. So that would incentivize, that change in behavior. Yeah, it just depends on the industry, the trading partner, et cetera.
Yeah. All right. Well, let's jump into tariffs expand to export taxes. So, this is interesting. Tariffs have been a key focus of the Trump administration's economic plan, with the idea that is that the U.S. will use its trade deficit, normally a weakness, as a strong bargaining chip to either entice companies to produce goods for the U.S. market in the U.S. or pay a tax to offset the negative impact. So, pretty interesting strategy. I don't know the histrionics of this, if this is the first time this has been approached. But yeah, what are some of the nuts and bolts around this?
Yeah, I think this is something, I mean, we've talked about tariffs a lot. Again, the jury's still out, right? There's a lot of moving pieces, but this shift in strategy towards export taxes, I think fairly concerning, right? The U.S. Trump met with several manufacturers of the very advanced microchips where U.S. companies have a strong competitive advantage, and specifically they were banned from selling a lot of these chips to China. To try and make sure China can't use them for military equipment, things like that. There's been lots of time periods in history where that type of policy was put in place, where it's less about the economics of it, but more about defense. But now there was an agreement between several of the U.S. Key producers that they would be able to sell to China as long as they paid a percentage of the revenue to the United States government. I'm not sure what that really accomplishes. It still allows China to get access to those chips, and really it's just kind of the government creating these barriers that didn't exist before for companies to be able to export. And the hope is that this won't spread and become a bigger issue. I think also, kind of between when we wrote this article and now, there's talks about the U.S. government taking a stake in Intel, right? Also in the microchip. Again, it historically has not been the purview of the government to be investing in U.S. companies, and when they have, it has typically not gone well.
Right.
It's not gone well for the government in terms of lots of cases of big losses. It also has not gone well for the country, for the companies. It's a lot of the companies I don't think realize it can be very dangerous to take money from the U.S. government because you may have an existing agreement, but the government has a tendency to continue to change that agreement more and more in its favor, and it kind of can hold that loan or that investment over those companies as the reason why now they need to conform to all these different things that may have nothing to do with the business reality. So it is. I think it's something that we're going to have to watch. I think it is a concerning area. Now, I will kind of steelman the opposite side in terms of the argument, which is if we completely cut the Chinese market off from these chips, it'll create more of a powerful economic incentive for them to catch up, right? To invest a lot of money in producing. Whereas if they can buy them less expensively from U.S. manufacturers, then there's less of an incentive, right, for them to put in the large amount of investment that it would take to catch up. So maybe it allows us, to keep that advantage or at least that larger advantage for longer. I think that's kind of a reasonable argument from a national security standpoint. But again, what does that have to do with an export tax, right?
Right.
Why would you then apply an export tax on there if there's a belief that you actually want China to be using U.S. chips and be dependent upon U.S. chips?
Yeah, it is really interesting. I bet it would be an incredibly challenging scenario for newer companies, especially trying to gain that capital to continue to grow.
Yeah. Well, it could be. I mean, if this were to expand, it could be very detrimental to, companies that are at kind of that key size where they've developed a U.S. market and they want to expand internationally. That obviously is going to come with a lot of investment and cost, and the benefits may not be seen for years or even decades into the future. And if you add an additional cost to doing that, it may make those investments unattractive. And situation where we have these strong companies in the U.S. that are really global brands, global, superpowers or national champions, as they often call them. It could make it harder for those companies to develop in the future.
Yeah. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. Got two items pinned up there.
Yeah, so the first is something that's come up. The labor market's tightened up a little bit, and there's been a lot of reports that a lot of people are going on job boards and things, right, and posting what they're calling ghost jobs. Basically, there's no real job. What they're trying to do is just steal personal information from job hunters. Right. So it says, oh yeah, there's a job available. Okay, provide us with a bunch of your information. You're not going to get a call back. You're not going to get hired. But then they're either going to, take that information and put it on the dark web where fraudsters can use it, or maybe sell it to companies that are looking to do marketing or things like that. So it's just something we wanted to point out because it's become so prevalent that a lot of times it's best to, confirm that there's a real job listing out there on a company website or contacting a company directly, instead of just going through some of these internet message boards where, you want to be very careful about giving your personal information, even if there's a really attractive job out there and you want to try and jump on it, right? You might be giving something away and you're not really going to get any opportunity in return.
Yeah. All right. Well, what's the second item we've got pinned up there?
All right. So this one, so anyone who's received an email from us recently probably sees at the bottom of the kind of, the main body of the email, we've put in a disclaimer, and, we put it in as very prominent because we think that it's one of the most important things that we really need clients to pay attention to, right? So the disclaimer says, as a reminder, please do not attach documents or send information through email if it contains personally identifiable information, right? Basically, what we want is for people to let us know, and we can send them a secure email link, right? Plan Solutions, I can tell you, spends a lot of money on cybersecurity, both in terms of our budget and training and everything to try to keep a company safe, try and keep our clients' information safe. And unfortunately, often the weak link in that chain is, clients using a free email provider, right? That maybe they've had for years that does not have that same level of protection. And so if they attach documents that can include their personal information, a lot of times it's that initial, stage of where they're initiating that email that's the dangerous part, right? Before it even gets to us. Whereas a secure email link, if they upload it, it creates this secure handoff between their computer and our computer. So much less likely that an email hack or something like that, could result in identity theft.
Yes, sir. Yes, sir. Anything else you want to add while we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, kind of just on the topic we just talked about, just let people know it's always best to just give us a call, right?
Yeah.
Give us a call and go through what's the best way to do this. I know it can take a couple minutes extra time, but obviously a few minutes of extra time versus a long time period of trying to fix a problem is generally a pretty good trade-off.
Yes, sir. Absolutely. And if you do want to place that call to Plan Solutions, that information is in the podcast description. As well, if you want to subscribe to the Personal Financial Review, the written content that we discuss here on the podcast, it's released bi-weekly. Send Katie an email at katie@plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.